Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoan, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions.
This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Today, we're discussing an intriguing trend in Ontario's real estate market, the significant share of home purchases being made by the youngest group of first-time buyers. According to data from Teranet, the province's land registry agency, individuals aged 30 and younger account for a large portion of these purchases, particularly in the condo market.
That's right, Steve. It's fascinating to see how the younger generation is stepping into homeownership despite the well-known affordability challenges in Ontario. In fact, they made up 41.5% of solo condo purchases and 38.5% of single-family home purchases over the past 5 years.
It raises a lot of questions about how these young buyers are managing to enter such a competitive market. Teranet suggests that financial support from family or other sources might be playing a role here. It's also interesting to note that this trend mirrors the buying patterns of older first-time buyers, those between the ages of 30 and 40, who are usually on a higher income bracket.
Yes, and the data also shows a shift in how these purchases are being made. More first-time homebuyer condo purchases are happening individually rather than as couples. This is a reversal of the trend we saw after 2015 when stricter mortgage rules came into play.
Emily Chung from Teranet highlights that this change could be due to alternative financial help, although it's not definitive. Another point from the report is that first-time buyers are leaning towards resale properties. Only 20% opted for new builds, likely because older condos are more spacious and affordable.
That's a great point, Steve. Affordability is key, and it seems the younger buyers are savvy in choosing options that balance cost and space, even if it means avoiding pre-construction condos. This preference has contributed to a slowdown in pre-construction sales, the worst since the 1990s in the Toronto area.
And let's not forget the federal government's role in trying to assist these young buyers. They're proposing legislation to waive the 5% federal goods and services tax on pre-construction homes for first-time buyers who plan to live in the property. This could potentially ease the financial burden and encourage more young people to enter the market.
Absolutely, Steve. It's encouraging to see measures being proposed to make homeownership more accessible. With the typical home prices in Canada reaching $693,300 in July, and even higher in the Toronto region, every bit of financial relief can make a difference for these young buyers.
So, Janine, let's dive into the current state of Canada's housing market. According to the latest data, there seems to be a slight thaw happening, but it is not the booming recovery some might have hoped for.
Yes, Steve. It appears that while national sales have increased over the past 4 months, the recovery is highly regional. Markets like Toronto are still seeing a lot of listings, and the activity is quite muted compared to previous years.
Exactly. And John Lusink from Right at Home Realty mentioned that even though there is a slight uptick, the market is still a buyer's market. The number of listings has remained high, which means buyers have more choices, but sellers might not be seeing the prices they want.
That's true, Steve. It's a bit of a mixed bag. While some buyers are finding slightly improved affordability due to small dips in required income and stable prices, the improvements are not substantial enough to make a significant difference for many.
Right, and Lusink also pointed out that the ongoing economic tensions, particularly the trade war with the United States, are adding to the uncertainty. Many potential buyers are hesitant because of these broader economic issues.
Absolutely, and while affordability has improved in 12 out of 13 Canadian cities, with Toronto leading the gains, the changes are minor. For instance, in Toronto, even after a $4,040 decrease, the income required is still above $200,000, which is beyond reach for many hopeful buyers.
And looking forward, it seems a full market recovery is not expected anytime soon. RBC has indicated that factors like a fragile labor market and reduced immigration targets will continue to limit growth. They do anticipate some price gains in regions like the Prairies and Quebec, but Ontario and British Columbia might continue to face challenges.
Yes, and it is interesting to see how these regional differences play out. While some areas might experience positive changes, others are likely to struggle with imbalances, particularly in the condo markets in Toronto and Vancouver. It's a complex situation that will require careful navigation for anyone involved in the market.
Janine, let's delve into the current mortgage rate conundrum in Canada. For the first time in nearly 3 years, fixed mortgage rates have surpassed variable rates, creating quite the dilemma for potential homebuyers. With fixed rates hovering above 4%, many are questioning if we'll see them dip back to the mid-3% range anytime soon.
It's definitely a challenging decision for buyers, Steve. The uncertainty surrounding inflation and the overall economic outlook makes it tough to predict the future of these rates. Victor Tran, a mortgage expert, suggests that the bond market plays a significant role in influencing fixed rates. As inflation slows, there's potential for bond yields and, consequently, fixed rates to decline. However, this is contingent on numerous factors, including economic policies in the United States.
Exactly, Janine. The bond yields for Canada's 5-year bond have been on a bit of a roller coaster, fluctuating around the 2.9 to 3% range. These yields are closely tied to expectations around central bank interest rates. The current high yields are partly due to persistent inflationary pressures and the influence of U.S. fiscal policies. If inflation remains sticky, we might see these yields remain high, impacting fixed mortgage rates.
And that adds an additional layer of complexity for homebuyers trying to decide between fixed and variable rates. Variable rates, while initially cheaper, come with their own risks. Victor Tran points out that while variable rates can save money, they require a higher risk tolerance. If the Bank of Canada's rate decisions could cause sleepless nights, a fixed rate might still be the safer choice for those seeking stability.
Victor also mentioned that even though we might have missed the absolute lowest rates from earlier this year, we are only about 0.5% away from those historic lows. This means that the difference might not be substantial depending on one's mortgage amount and personal financial situation. It's a reminder that timing the market perfectly is nearly impossible.
That's a good point, Steve. It's important for buyers to assess their own financial comfort and risk tolerance. While some might be comfortable with the potential fluctuations of a variable rate, others may prefer the predictability of fixed rates, even if they are slightly higher. It really comes down to personal preference and financial planning.
Absolutely, Janine. As always, the key is to make informed decisions based on the most current data and personal financial circumstances. Whether buyers lean towards fixed or variable, understanding the underlying factors and potential risks is crucial in navigating this mortgage rate roller coaster. Janine, let's talk about the latest insights from Equifax on mortgage demand in Australia. The data shows a significant rise in mortgage demand, driven largely by refinancing activities. This trend is intriguing, given the current economic conditions.
It is indeed, Steve. Equifax's Consumer Pulse Insights report highlights that in July, mortgage demand increased by 6.4% compared to the previous year and 3.7% from the previous month. This rise is quite telling, especially considering the Reserve Bank of Australia's decision to maintain interest rates earlier in July, which did not seem to deter consumer interest.
Right, and with the Reserve Bank's recent rate cut in August, lowering the cash rate by 25 basis points to 3.6%, it seems likely that this trend will continue. Kevin James from Equifax mentioned that further rate cuts are anticipated, which could further fuel this demand.
Absolutely, and it's interesting to see that refinancing is playing a major role here, making up 36.2% of total mortgage demand in July. Homeowners are really taking advantage of the falling rates to secure better deals on their home loans. It's a smart move, especially in a fluctuating market.
However, new mortgage originations seem to be struggling a bit, with a slight year-on-year decrease of 0.8%. Although there was a month-on-month increase, the challenges for first-time homebuyers remain significant. The demand is there, but affordability and competition continue to be major hurdles, especially in metropolitan areas.
It's a tough situation for first-time buyers, Steve. Even with increased borrowing power, the heated property market makes it difficult for many to make a purchase. The allure of home ownership is strong, but the practical barriers can be overwhelming.
On another note, the demand for unsecured credit is also rising. Personal loans have seen a 17.6% increase year on year, and credit card applications are up by 7.3%. Yet, both categories have dipped slightly month on month.
That's right. And the buy now, pay later sector is showing substantial growth year on year with a 56.2% increase. However, there was a noticeable drop of 7.3% month on month, likely due to new regulations introduced in June. It's a rapidly changing landscape for unsecured credit.
And let's not forget about auto loans, which have softened slightly. Applications are down 0.5% year on year, reflecting a decrease in consumer spending on vehicle finance. It's a complex picture, but understanding these trends is crucial for brokers and consumers alike.
Definitely, Steve. For brokers, recognizing these shifts in refinancing and new mortgage origination can help them better serve their clients. It's about navigating the market effectively to find the best possible deals and opportunities.
Janine, we're seeing some interesting developments in consumer credit performance across Canada. Equifax Canada's latest Market Pulse Quarterly Consumer Credit Trends and Insights report indicates early signs of stabilization in consumer credit performance for the second quarter of 2025. This is particularly evident among mortgage holders, though those without mortgages, especially younger Canadians, continue to struggle with financial pressures.
That's right, Steve. The report mentions that nearly 1.4 million Canadians missed a credit payment in the second quarter of 2025. While this is 7,000 fewer than last quarter, it's still 118,000 more than the same time last year. It seems that while the overall delinquency rate is leveling off, the underlying factors are quite complex, especially with the financial strain on younger Canadians due to a slower job market and rising costs.
Exactly, Janine. Rebecca Oakes, Vice President of Advanced Analytics at Equifax Canada, pointed out that the gap between mortgage and non-mortgage holders is widening. In the second quarter, the percentage of non-mortgage holders who missed a credit payment was nearly double that of mortgage holders. This disparity has grown significantly over the past few years, highlighting the financial challenges faced by non-mortgage consumers.
It's concerning, Steve. The report also notes that the total consumer debt climbed to $2.58 trillion, with average non-mortgage debt per consumer rising due to increasing costs for essentials like vehicles, groceries, and housing. Interestingly, consumer spending on credit cards is declining when adjusted for inflation, though spending among non-mortgage holders has slightly increased year over year.
Yes, and regionally, Ontario is experiencing sharp increases in missed payments on non-mortgage products, particularly in areas like Toronto and Hamilton. These increases are driven by high living costs and economic uncertainty. Alberta is also seeing a rise in delinquency rates, attributed to a recent population surge and economic challenges.
It seems like financial stress is hitting different regions and demographics in varied ways. For instance, younger Canadians, particularly Gen Z and late millennials, are feeling the pinch with rising non-mortgage debt and high delinquency rates on credit cards and auto loans. It's a tough situation, especially with employment uncertainties and limited access to affordable credit.
That's true, Janine. Despite these challenges, the mortgage market is seeing some growth, primarily through renewals and refinancing of low-rate mortgages from the pandemic era. However, first-time homebuyer activity is not as strong in major markets like Ontario, British Columbia, and Alberta, indicating underlying financial strain.
And with auto loans, while there's been a small increase in originations, it's mostly limited to low-risk consumers as lenders tighten their approval criteria. Rising vehicle prices are also a concern, adding to the financial pressures on consumers.
Rebecca Oakes concluded that while delinquency rates may be stabilizing, challenges remain. High costs of living, food inflation, and regional economic pressures, particularly in Ontario and Alberta, continue to weigh heavily on Canadian households. It's clear that credit performance will be a critical issue, especially for younger consumers, well into the second half of the year. The yield on the Canadian 10-year government bond has dipped below 3.43%, as expectations of a dovish turn in monetary policy across North America influence the bond markets. This shift comes in response to signals from the Federal Reserve Chair, Jerome Powell, about increasing downside risks in the labor market, while also emphasizing concerns over inflation expectations. This has led to a repricing of U.S. 10-year Treasury yields, which has subsequently affected Canadian bonds as well.
Right, Steve. The market's response reflects a broader anticipation of a more accommodative stance from central banks, given the economic signals we're seeing. In Canada, for instance, retail sales are projected to have dropped by 0.8% in July, marking the second sharpest decline in over a year. This suggests consumers might be pulling back amidst ongoing trade uncertainties, which could be a concern for future economic stability.
Absolutely, Janine. The data underscores a volatile consumption pattern, which is significant given that retail sales are a major component of the economy. Additionally, the core trimmed mean inflation held steady at 3.0%, just under the anticipated 3.1%. This suggests that inflationary pressures might not be as intense as previously thought, potentially reinforcing the case for the Bank of Canada to adopt a more accommodative policy.
And let's not overlook the labor market, Steve. The unexpected loss of 41,000 jobs in July against a forecasted gain of 13,500 has left the unemployment rate unchanged at 6.9%. This is quite telling of the challenges faced by the workforce and adds to the argument for a more supportive monetary policy to help stabilize the economy.
Indeed, Janine, these economic indicators are crucial for understanding the potential direction of monetary policy. With both inflation and employment showing signs of strain, the Bank of Canada might be inclined to ease its tightening measures. The interplay between these factors and the bond yields highlights the complexity of the economic landscape we're navigating.
It's definitely a multifaceted situation, Steve. As investors and consumers, it's important to stay informed and adaptable as these economic conditions evolve. The potential for changes in policy can have a significant impact on everything from investment strategies to personal financial planning.
Janine, let's delve into the realm of Canadian mortgage-backed securities and the intriguing potential they hold for income investors in today's low-yield environment. The BMO Canadian MBS Index ETF, trading under the symbol ZMBSTO, is particularly noteworthy for its monthly dividend of CAD 0.06 per unit, yielding 1.57%.
That's right, Steve. This ETF is attracting attention because it offers a steady income stream, which is quite appealing given the current economic climate where traditional fixed income assets are not performing as well. The ETF's diversified maturity ladder, spanning from 2028 to 2030, and its mix of government-guaranteed and private label MBS help reduce interest rate risk while maintaining consistent cash flows.
Absolutely, Janine. Investors are finding a middle ground with ZMBS.TO, as it stands between the volatility of equities and the low yields of bonds. With an expense ratio of just 0.17%, it offers a tax-efficient interest-based distribution, which is attractive compared to higher-risk alternatives like the BMO Covered Call Canadian Banks ETF, which yields 6.22%.
And while the yield of 1.57% might seem modest compared to some other options, the stability it provides is significant. The ETF's asset composition includes MBS with interest rates ranging from 0.01% to 4.10%, ensuring a diversified income stream. This stability is crucial for investors who are cautious about the unpredictability of the market.
Exactly, Janine. The strategic appeal of ZMBS lies in its ability to cushion against the risks associated with rising interest rates. Unlike traditional bonds, MBS are less volatile due to their prepayment risk characteristics. When rates rise, homeowners are less likely to refinance, which preserves the cash flows of MBS, offering a level of predictability that is reassuring for income-focused investors.
However, it's important to note that ZMBS is not without its risks. It's sensitive to changes in interest rates and dynamics in the housing market. A surge in mortgage defaults, though currently unlikely given Canada's stable housing market, could impact its performance. Thus, it's best used to complement other fixed income holdings for a balanced portfolio.
Indeed, Janine. For those looking to diversify their income portfolio, pairing ZMBS with short-duration government bonds or high-quality corporate bonds can provide a more balanced approach. The tax-efficient structure of ZMBS is also beneficial for those in higher tax brackets, as its distributions are primarily treated as interest income, which could offer more favorable tax treatment than dividends.
Absolutely, Steve. In this low-yield era, finding reliable sources of income is challenging, but options like ZMBS can offer a blend of yield, stability, and cost efficiency. As always, due diligence on macroeconomic risks and careful portfolio diversification remain essential to navigating these investment waters successfully.
Janine, let's shift gears and discuss the recent enforcement action by the Financial Services Regulatory Authority of Ontario against Shawn Leonard Ruccia. This is a significant development in the regulatory landscape for mortgage professionals in the province.
That's right, Steve. The FSRA has issued a notice of proposal against Ruccia, alleging that he is not suitable to be licensed under the Mortgage Brokerages, Lenders and Administrators Act 2006. The allegations are quite serious, suggesting that his past conduct indicates he may not deal or trade in mortgages with the necessary integrity and honesty.
Indeed, Janine. The FSRA's allegations also include a failure on Ruccia's part to take reasonable steps to ensure that the mortgages presented to borrowers were suitable. This is a critical issue because it's directly related to consumer protection, which is a cornerstone of the FSRA's mandate.
Absolutely, Steve. The notice of proposal also mentions that Ruccia's actions led to the brokerage contravening specific subsections of Ontario Regulation 188/08. As a result, the FSRA is proposing to revoke his mortgage agent Level 2 license and impose an administrative penalty of $70,000.
These proposed actions underscore the importance of adherence to regulations in the mortgage industry. The FSRA's role is to ensure that professionals in the field act in accordance with the law to protect borrowers from potential misconduct.
And it's worth noting, Steve, that Ruccia has requested a hearing before the Financial Services Tribunal regarding this proposal. This indicates that he is seeking to challenge the FSRA's decision, which is a right under the regulatory framework.
Yes, Janine. It will be interesting to see how this case unfolds and what the tribunal decides. The outcome could have implications for how similar cases might be handled in the future, setting precedents for the mortgage industry in Ontario.
It's a reminder for all of us in the industry to remain vigilant and committed to ethical practices. Ensuring that mortgages are suitable and presented honestly to borrowers is essential for maintaining trust and integrity in our profession.
Absolutely, Janine. As we wrap up this discussion, it's clear that the FSRA's actions are part of a broader effort to safeguard consumers and uphold the standards of the mortgage industry. It's crucial for all professionals to stay informed and compliant with regulatory requirements. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time, and stay informed with the latest industry insights.